Making its decisions, our own Reserve Bank will also look at commercial activity when deciding on rates. Retail sales came in stronger than expected. They grew by 3.4% in April compared to the same month last year. That's almost 8% higher than the growth recorded in March. SABC says that on a month-to-month basis, sales ticked up by a fifth of 8%. So all this data coming in, determining what our interest rates will be if we save or borrow. Let's bring it home. What does it mean for you and me to discuss? We're now joined by Owen Nkomo from Nkunzi Investments. Great to have you with us, Owen.
Thank you, Francis.
So let's start with the retail sales and what we were talking about off air. How come they are so strong when our economy is so weak?
Yeah, it was quite a surprise, but some of these data points tend to be very sporadic. So the question is, where are these people getting the money to shop from? Because everywhere we read, we're told everyone is indebted and they're struggling to service their credit cards.
And we're told the banks are being quite careful, so
Exactly.
They shouldn't be getting reckless loans.
Yes,
in
absolutely.
theory.
And I think most of the banks have indeed cut back on giving loans without doing some stringent tests on the people they are giving money to. So it's a pleasant surprise actually for the retail sector. It's one of those signs that may potentially give maybe the Reserve Bank governor one of those few elements that say, hey, things are not all gloomy. So people still have a little bit of spending power after all. But I think maybe this is a seasonal number. Potentially may get a different number going into the next reading.
So you have to wait for a trend.
Yes.
Okay, let's look at the big Fed Reserve watch. We're not expecting the US to raise rates today, but all investors will be hanging on every word of Janet Yellen as usual. What are you expecting?
Yeah, I mean, it's almost becoming like this, the Greek and the EU saga that's been running for months and months. So this one is us and Janet Yellen, you know, where we think, is she going to do it now? Is she going to do it next month? No, in the next 6 months? And it's a guessing game.
She enjoys it.
Exactly, and I bet you she does enjoy it. So I think the rhetoric is going to be more around the guys trying to get an idea of when the next interest rate hike is going to be in the USA. But I get the sense that Janet Yellen is going to keep to her word and say that I will be guided by data. If the data suggests that we should start increasing interest rates, then we'll do so. And at the same time, I do believe that this time around, there is room for them to wait it out a bit. Because remember, the market has been looking for a rate hike starting from last year, thinking beginning of this year we'll get an interest rate hike. It didn't happen. So we believe that there is room for them to potentially say, maybe in September, let's tweak the rate higher by 25 pips. Then they can wait for a period of 3 to 6 months before they do another round of rate increases.
This is important for us because we may, if the US raises interest rates, we probably will. Some saying that we'll raise rates before the US because we're also looking at inflation. So look at today's inflation number. What does that mean for us and interest rates?
Yeah, so the inflation numbers came through slightly ahead of what the market was looking for, or rather what we were looking for in particular. And I do think that you are right. It's not about us waiting for the US to start pushing interest rates higher. I think that if the interest rates in the US starts going higher, we'll only potentially start increasing our rates at a faster pace. I do believe that the market is pricing in already a 25 basis points rate increase, considering that last time the governor gave us a rate decision, the R186 bond, for example, was still trading 20 to 30 basis points lower than it is at the moment. So I do anticipate that we will get an interest rate hike before the US increases interest rates. So obviously, you know what that means. It means you and I will have to pay more for our cars, for our credit cards, and for our holidays. It's no longer Paris, it's going to be Paris. You know, we need to be careful with our budgeting.
0.25% or 25 basis points, not much of a change. Is that enough to change things?
I really think it's not much, because look at it this way. The last rate increase was about last year sometime, I think, in July. So we've been able to wait it out until now. It's all digested, I feel. And I think that 25 basis points is a modest and fair assumption for the upside on interest rates.
And that is as early as July.
Definitely. That's what the market is calling for. And I think it's going to be a tough one, because on the one hand, you've got people not being employed, economy is sluggish, but Mitsahanyaho is stuck between a rock and hard place when it comes to this interest rate decision. If we are reactive, it could be potentially a problem. But I think what the market is saying is that he's got to do this now, or he's going to be behind the curve.
There's also always been this concern, which I think the Reserve Bank used to address, and it no longer talks about it. The fact that our inflation is imported or external, because at one stage oil prices were going up, we import petrol, now we've got the weak rand, so everything we import is more expensive. Is that still the case, where we're facing inflation, but it's not really because these retail sales are strong?
Exactly, you're right. I mean, we import our oil, and to an extent, you've started to see that this drought that is currently going on in most of our agricultural productive regions of the country is now starting to have a negative impact on availability of stuff, such as maize. We're going to be importing, so you're importing food. And on the one hand, the currency has weakened significantly. You're looking at the rand trading at 14 to the euro, trading at 19.35 to the pound, and weakening aggressively against the dollar, 12.35. So it means everything we're importing now costs us more. So oil price, yes, it did come off, but you know what? It's now trading 30% higher than it was trading at its lowest price. So all of those things mean we are importing oil, or rather we're importing inflation by virtue of a weakening currency. And
the weakening currency is the huge concern. Firstly, could we see it move tonight if there's just a hint of an earlier than expected rate hike in the US? We've already seen the rand react. It's very volatile. And the next question is, do we even know what's going to really happen when the US does, in fact, raise the interest rates and stops talking about it?
We don't know exactly, but we can surmise that given the current volatility, like you asked the question, what will happen to the currency tonight? If there's any hints that we'll get interest rates starting to tick up in the USA earlier than we're expecting, the rand will weaken, so too will other emerging markets currencies. And trust me, once this cycle of interest rates being low starts in the USA, the emerging markets currencies are going to get sold off. And I potentially think that could be the beginning of a correction in emerging markets. Once the US interest rates start to push up, people are going to transfer their capital back into the USA. The dollar is going to strengthen against all the other currencies.
Will it be chaotic? I spoke to S&P based on their recent credit rating decision, and they said they are expecting an orderly hike of rates starting in the US. Do you think that may not turn out to be as orderly as expected?
No, I think as I said earlier, probably if they're going to increase interest rates in September, they'll do 25 basis points, wait maybe for 3 odd months to see the second round effects of that decision and see what else is happening around the world. If the Eurozone starts to tick higher, then it gives the US confidence to continue to increase interest rates. But they're not going to be all over the show.
So it will be slow.
I think it will be slow, definitely. But the reaction of the market, on the other hand, in the beginning, it will be quite drastic. I think the market will lose some serious ground, and over time we'll start to assimilate the fact that the Fed is going to do things in a more structured and measured pace, like Ben Bernanke used to say.
So I guess the message for the ordinary South African here is that interest rates will go up, so expect that if you're in debt, and prepare for that. And maybe if you're not a professional, do not start investing on the JSE, because like you say, there could be a correction.
Yes, we've been expecting, unfortunately, correction for a long time. And let it also be remembered that even if we'll start to see interest rate increases coming through, we're still trading at all-time lows for interest rate instruments. So I do believe there's room for people to continue to be cautiously investing in the markets. Just take caution, though, small sizes, and just be patient and see what happens.
Well, I don't know. If it was me, I would wait until the US finally makes up its mind. But like you say, a lot of people have been warning. Exactly. And we've been warning of the JSE going down for some time. It's just like Janet Yellen. Thank you so much for your analysis tonight. That was Owen Nkomo from Inkunzi Investments. Well, let's take a look at the country that's causing jitters on the markets currently, Greece. A top Greek negotiator has told Reuters today that the country is willing